Hello there. I'm Bella, and welcome to the Business Safari. Today we're diving into the world of balance sheets. A balance sheet is like a snapshot of a company's financial health at a specific moment. The balance sheet shows three main things: assets, liabilities, and equity. Let's break this down into much simpler terms. Assets are things the company owns that have value. For example, cash in the bank, inventory to sell, equipment used in the business, and buildings the company owns. Think of assets as the items or resources that the company possesses. Liabilities, on the other hand, are what the company owes to others. This includes money borrowed from banks, bills that need to be paid, wages owed to employees, and taxes due to the government. You can think of liabilities as the company's financial obligations or debts. Finally, we have equity. Equity is what's left over when you subtract liabilities from assets. It represents money invested by owners and profits the company has kept over time. Equity is essentially what the company is worth to its owners. Now, here's the key thing to remember. On a balance sheet, assets always equal liabilities plus equity. That's why it's called a balance sheet. From another perspective, you can also see that assets minus liabilities will always equal equity, or what the shareholders own in the company. This equation always stays in balance. For example, if a company buys a new computer, which is an asset, it must either increase liabilities like taking out a loan, or increase equity like using saved profits. And there you have it, the basics of a balance sheet. Remember, assets are what the company owns, liabilities are what the company owes, and equity is what's left for the owners. Understanding balance sheets helps you see the financial position of a company at a glance. That's all for today's Business Safari. I'm Bella, and I'll see you next time. And don't forget to subscribe to our channel for more helpful business videos.